What is going on, guys? It's your favorite mortgage lender, Abdel Kwatmi. I hope you guys are having a blessed day. Man, we've been getting some crazy rain the last couple days. Thank God it finally let up today because God knows it's been a little wacky. I've got some work being done to the house, and my backyard looks like a mess right now. Um, Now, what are we going to talk about this week? Again, we're always going to go over scenarios during this time. Couldn't jump on yesterday, so I wanted to make sure we get these scenarios out and go over specifically some of the different client approvals we've been able to obtain this week and some of the scenarios we've run into. So the first one, received a phone call from a real estate professional yesterday. Client is having difficulties with her current lender. She was pre-approved previously, but then now the lender is obviously having a little bit of second thoughts. It's a larger institution. I'm not going to name any banks. And then what they ended up actually doing was basically stringing the client along and not getting the file approved. Eventually, we got the file, and I was able to figure out the best strategic avenues based on guidelines for us to qualify the client. So the client is a self-employed borrower. So what we're doing is we're utilizing a self-employed, let me correct myself. She was a self-employed borrower until she wasn't. Self-employed borrower since 2019. So I got copies of the client's 2-year recent returns filed, 2022 and 2023, and made sure that it showed the self-employment. Now, the borrower just started a W-2 job in August of 2023, so a little over the halfway midpoint. Now, the requirement, again, comes down to specifically what are the examples of consumers running into a working history expectations. So what did we do? We utilized the client's self-employed history for working history and now can actually use 100% of the client's proposed salary because it is guaranteed as a W-2 employment. We've already prepped the file for underwriting submission, and we're working on getting it submitted to our underwriters tomorrow. I confirmed with one of our underwriting managers today that we should be perfectly fine with that game plan, and we're pushing the file through. A different file, if you guys remember, about 2-3 weeks ago, I was talking to some consumers talking about what the condo issues that we're running into. So we were unfortunately unable to get 2 condos done from a traditional perspective. They're both located in Florida. They both had a lot of structural issues involved, which is very typical. So now what we're doing with those specific 2 properties is we're actually going to be changing it to some hard money loans. Still pretty favorable terms to the client, and simultaneously making sure that they still have access to the capital, and we don't necessarily need to do a deep dive specifically into the paperwork that they're going through, because it just unfortunately wouldn't work traditionally. Now, on a third unit, we were able to get done traditionally. We got an exception from one of our investors. They were able to give us the exception of the high occupancy. So I'm going to backtrack. So what are the things that we usually have issues with when we look at condos? So the main parameters of what we are required to look at specifically is what does the consumer, or what does the HOA, I should say, how much is their reserves? How does their budget look? What are the specific scenarios that they're running into if there's any lawsuits involved? And then a new one that's been kind of being a little sticky recently has been issues with life and safety hazards. So if you guys remember, and I've shared this in my past videos, back in 2021, those condos went down in Florida. What that ended up doing was now changing a lot of the rules and regulations with Fannie Mae, not Abdel's bank, not ABC Bank. Fannie Mae specifically changed the rules now, and now we have to ask for further information in regards to any life and safety hazards or failed inspections or anything of that nature, and what is the HOA doing to address these issues. Okay, it is so critical for us to understand the position because, again, it's a huge liability. So from a banking perspective, we are required under the secondary market regulations with Fannie Mae and Freddie Mac to get a deep dive into that information and figure out specifically what the best options are for the clients, and most importantly, if it's an even very favorable investment, I guess you could say, right? Because you definitely don't want to make sure that a client is getting into a property that necessarily doesn't work. I'm a firm believer in that. We want to make sure the clients are always taken care of, and we take it from there. A few different clients. So if you guys remember that 203K file I was talking about, was a little tricky. So 203K is a rehab loan via FHA financing. We were actually able to get the client approved, push the file through. We finally got the final contractor bid and consultant all done. We were able to get the preliminary closing disclosure out to the borrower, and I am pushing for it to close more than likely middle of next week. I'm buying us a little bit of time till I said next Friday, but we now have the ability to get this all wrapped up and at the same time push the file to the closing table, right? So that was a really tricky one because we were dealing with a few tenant issues. We were dealing with a few concerns with the client in terms of their payments, but regardless, the proper expectations were set, and the client now knows exactly um, when her next payment is due because we're actually creating a 3-month contingency reserve, meaning she does not have to make any mortgage payments while the house is being fixed, which is a huge plus. And the client was able to do it from there, right? Another consumer who just sold their property um, utilizing a VA loan, we're actually restoring their entitlement from the VA loan. So, what does that mean? Backtracking. So, whenever you're a veteran, you usually have a specific allotted amount of what's called your certificate of eligibility based on your entitlement, right? I'm not sure what their algorithm and how they calculate it is, but usually it's based off of your certificate of eligibility. It would tell you what your remaining eligibility is left, and that is essentially the guarantee for the VA, the Veteran Affairs, to cover your mortgage and cover the insurance that is required through them specifically. So this client sold the house. Credit score is a little on the lighter side. So what we're doing is we're actually utilizing the proceeds from the home sale. We structured it correctly from the beginning with the real estate professional to do essentially a 45-day, about almost 60-day, a 60-day UNO, which is a use and occupancy, meaning they can still stay in the property for 2 months and still be able to live there. They would just have to pay back the borrowers who are now are technically the owners of the property for them to live in it while they work on obviously closing on this new property. This kind of buys us a little bit of time to do something called a rapid rescore and basically have the client pay some of their high credit cards that they had from their home proceeds, do a rapid rescore, fix their credit quickly, and still simultaneously get them approved, right? So a lot of different scenarios that we would run into. Um, Anyone who has any questions or anything of that nature, if you could request a loan, you're more than welcome to send me a message privately. I'd be more than happy to help and dive through all the different scenarios that you want to make sure that when we're talking about a consumer, like those examples I'm giving you guys, right? I always bring it back to something called the 4 C's. We want to look at the client's credit score. If credit is light, we need to figure out what is specifically going on. And remember, we have a financial fitness application with my team. You can download it from the App Store, Paramount Data Vault, put Got Mortgages One. It'll get you immediately access to it. It is 100% for free. If you guys want more information on that, feel free to message me later. I'd be more than happy to give you guys. Now, we take a look at credit. We take a look at collateral, which basically means what are you buying? And is the property in a good condition, or does it need a little bit of love, or does it need a little bit more attention as to what necessarily may not happen, right? We'll take a look at their capital. Where's the money coming from? Is the money seasoned? If it's not seasoned, can we get a gift? What are the strategic avenues that need to be employed? And then the last thing is obviously their capacity to repay the loan. Do they have the ability, based on debt to income restrictions, to qualify for the mortgage? Okay. So that debt to income restriction made a major impact with a lot of clients from qualifying. It's important that you set the proper tone in place from the beginning so you have that expectation set in place, right? Another consumer that we just actually got the clear to close, closing tomorrow. We added him as a non-occupying borrower. He's essentially the one heavily handling the income, and we're simultaneously able to still push the file through, even though the main borrower really necessarily wasn't making much money. We're utilizing the income of the original co-borrower to be able to help boost the debt to income restrictions. One deal that I'm dealing with right now, to be honest, I still haven't figured out the solution. We have an out with her parents co-signing, but this borrower is a home health aide. She is going through multiple jobs, which is typical in that line of work, but it's really hard to establish a consistency, obviously, within that type of employment. So what we're trying to figure out specifically is, has she stayed at her place? I mean, it is literally like, I would say weeks or even months. She'll work for somewhere, work for the next place, work for the other ones, or work 3 or 4 at the same time. 8 hours here, 9 hours there. So it's a little super, super tricky to piece together. But I already have an out. Client already knows the expectations. She already started the paperwork, to get her parents going, and we're adding them to the application. So so the tone was set in stone from the beginning. Um, Another borrower, actually, this is from one of my loan officers. They are adding. So it's the mom who's moving into the house. She's retired. She's collecting SSI. We're adding both brothers to the mortgage to help alleviate the debt to income restrictions and qualifications, and simultaneously still making it for them to be able to eligible to qualify. We do out of state loans. I'm licensed throughout the entire nation, and I do have bilingual speaking loan officers individually on my team. Should we need any assistance or anything of that nature, so I'm more than happy to help. Now, when we're going back to what I was talking about with understanding the client's conditions, what are they looking for truly, right? What do we think is the hurdles that the consumers will be running into, right? And that is critical because a lot of times clients just truly don't know exactly what is holding them back, or their expectations may be a little bit more. So it's critical for us to be able to educate the clients and set the proper expectations. That way, the clients have a firm understanding of, okay, so my credit's a little light, but if I do ABC, you'll be able to set the proper expectations and then take it from there. If you have situations where a client's income is a little lower, I've been doing a lot of non occupying borrowers. What does that mean? They do not have to live in the house. They just get added on as a non occupying borrower, whatever their current housing expense is. So if it's a rent, if it's a mortgage payment, we would count that against their qualified income and still be able to utilize the remaining income to be able to help the original borrower qualify. Okay. So a lot of different strategic avenues. Now you want to make sure and explain to the client that they are still 100% liable should the mortgage not be paid. So if the borrower doesn't pay for it, co-borrower is to an extent, liable for it, and 92 they are liable for it if you don't pay for it. So super important that we set that tone. I take an aggressive approach to obviously explaining all the options to the clients, and then fine tuning exactly what it is we need to do, and we take it from there. I appreciate you guys jumping on. I know we covered a lot. We went over my time of 10 minutes as I usually do, but I wanted to make sure this is literally what we deal with on a weekly basis. So in the last week, all the scenarios that I've told you guys now for the last basically 13 minutes have been what we've been going through. We are constantly working on getting some of the files done. Every single file right now, I'll be honest with you, is a little tricky. We're running into inspection hurdles, tenant hurdles, things on that nature. Our qualifications, sometimes the borrower says X and we verify Y, and then we have to pivot, but we are always pivoting. And we're all in and making sure that we're explaining things to our clients in the best terms. And then that way, if a hurdle comes up, we're not throwing in a flag. We are going to war until we figure out specifically what it is that we need to do to a client and turn every single rock until we're able to do so. I appreciate you guys jumping on. As always, I will be back on Monday for our market update live on Instagram, Facebook, and YouTube. I see all the comments, and I believe I answered everybody. So if you guys have any questions whatsoever, feel free to give me a chat, and I'll talk to you guys soon.